Hi, and welcome to The Good, The Bad, and The Bitcoin. My name is Dirk, and I've been an investor and trader for 25 years. In this first part of a video series, I want to teach you about option trading and how you can use options for your trading to amplify profits, better manage your risk, and greatly enhance your trading success. So if you ever wanted to get into trading options, but you did not know where to start, this video is what you have been looking for. At first glance, especially if you are a beginner trader, options might be something that appears to be very complicated. Especially when people suddenly start talking about things like intrinsic value, in the money, out of the money, vega, delta, and so on and so forth. But don't worry, it is really not rocket science. As with everything in life, it is, however, important to first understand the basics before risking your hard-earned money. In this first video, we will cover the basics. In future videos, I will then explain actual trading strategies to you and how I use them for my personal portfolio. I also share my own strategies and views on the markets daily on my free Telegram channel. You can find a link to it in the description of this video. Options are financial instruments that are based on the value of underlying assets such as stocks, bonds, or other type of financial products. They give the holder the right, but not the obligation, to buy or sell the underlying asset at a predetermined price known as the strike price, before or at the expiration date. Alright, that was quite a sentence, right? Let us look at a real-life example to get some more practical understanding of this. For this, we are going to look at options that are based on the stock of Tesla. So Tesla is the so-called underlying asset. Tesla is at the moment trading at around $220 per share. Let's say we think that the price of Tesla should appreciate over the course of the next month. In order to profit from this, we could of course buy Tesla shares. If we want to buy 100 shares, we would need to pay $22,000 for that. If we are correct that, let's say, Tesla stock price rises to $140 within a month, we would have earned $20 times 100 shares, so $2,000 in total. A solid profit of 9%, not bad at all. However, instead of buying the stock directly, we could also buy a call option on Tesla that, for example, gives us the right, but not the obligation, to buy the Tesla stock for $220 until the expiry date of the option 1 month down the road. For an option like this, we currently would need to pay $12.90, so in total $1,290. If the Tesla stock price then is at $240 a month down the road, the option of course would be very valuable, because we would have the right to buy 100 shares of Tesla for $220 per piece, while the current market price is at $240. As a matter of fact, on the expiration date, one option would be worth $240 minus the strike price, $220, so $20. $20 minus $12.90, which was the price we paid per option, gives us a profit of $7.10 per option, so $210 in total. Since we only had to invest $1,290 for the options, the return on investment is 55%. As you can see now already, the benefit of doing this trade with an option instead of directly with the stock is that you need to invest a much lower amount of money for the chance of a much higher return on your investment. So you could potentially use the rest of the money you wanted to invest in Tesla shares for other trades. However, this chance on higher returns on investment comes at a price. Should my opinion of the Tesla stock price become not true, and maybe even the price drops to $210 until the expiry date of my option, my investment of $1,290 would be gone, because the option is worthless. After all, why should I buy the Tesla share for $220 through my option if I could buy it directly on the market for $210? There are two different kinds of options that you can trade. In our Tesla example, we bought an option that gave us the right to buy the Tesla share for $220 until the expiry date of the option. This is a call option. With call options, you basically bet that the price of the underlying will rise until the option expires. If you buy an option that gives you the right to sell the Tesla share for a certain price until an expiry date, this is called a put option. You could, for example, buy a put option if you think that the price of the underlying asset will go down over a period of time, or you could buy a put option as an insurance for your existing Tesla shares instead of selling your stocks. You insure your stocks against losing value. As with any other insurance, for this you need to pay a price. This is called a premium. We've just learned that you can buy call or put options to bet on rising or falling prices of your favorite assets. But for everybody buying something, there also must be somebody selling it to them, right? When trading options, you actually can be that person that sells the call or put option to somebody. This is called option writing. Let's go back to our example with Tesla shares, where we had the opinion that the price will rise to $240 within a month. Instead of using my money to buy the stock or buy a call option, I could also sell a put option with a strike of, for example, $220, or as traders say, write a put option with a strike of $220. In this case, I would grant the buyer of my put option the right to sell 100 Tesla shares to me for the price of $220 per share until the option expires. For this, I receive the premium, so the $1,290 that the buyer had to put on the table for my option. Amazing, right? I got $1,290 into my account and made an instant profit. Why doesn't everybody do this all the time? I mean, we could be millionaires by tomorrow. You probably already know where I'm heading. I actually get the premium because I have a risk. Because imagine the price of one Tesla share falling to $180. Of course, the buyer of my put option would execute his right to sell the 100 shares to me for $220, right? That would mean I made a loss of $220 minus $180, $40 per share, or $4,000 in total. Even after taking into account the $1,290 I got as the premium, I'm still sitting on losses of $2,710. This is the important difference between buying and writing options. As a buyer, my risk is limited to what the option costs, but my potential profits are unlimited. As an option writer, my risk is unlimited, but my profit is limited to the premium I received. So why in the world should you even consider writing options if the risk is unlimited? Does that not go against every rule of risk management and common sense? Why it actually makes sense to also write options, and why options actually work more into the profit direction of option writers, plus how you manage your risk when writing options. These are things I'm going to cover in the next episode of my option trading masterclass. So make sure you leave me a like, subscribe to the channel, and activate that alarm bell to get notified when the next video is going to be released. Until we see each other again, happy investing.